Hi, this is Jared Rogers from Beyond Accountancy, and today I'm going to talk about how you can boost your first home deposit by using superannuation. This is a video for education of our clients and not advice. We're not property experts, we're not saying to buy a house or not to buy a house, or to use super or not to use super. Hopefully we give you some good ideas as to what you could do. So when I lived in Melbourne, we reported to our scumbag agent and landlord that there were a lot of issues with water damage and mold in our house, and they ignored us. I'm sure you can relate. We had to go to VCAT to force them to fix it, and here's what they found under the ancient layer of lino in our bathroom. The wood actually rotted right through to the underside of the house. The point I'm making with this photo is renting can suck. But owning a home in a big city is tough, especially in Melbourne or Sydney. And there's a lot you need to learn about the process to get through it. So in this video series, I'm going to run through some tips that might help you get from renting to owning, if that's what your goal is. So first, let's go through the basic steps. You need to save a deposit, arrange a loan, then you can go shopping for a house, find the one you want, make an offer. If it's accepted, you sign a contract, and then 30 days or 60 days or 90 days later, you'll settle on the contract, your lawyer or conveyancer, and finally, you have your first home. This video is about the first stage in the process, saving a deposit. Let's talk about the problem of saving a deposit. One of the reasons it's so hard to save a deposit is that Australia's individual tax rates are high. Most first home buyers are in the third or fourth tax bracket, so they're paying 34.5% or 39% tax when you add Medicare levy. Let's say you're in the 39% tax bracket for our examples today. That's $90,000 to $180,000. If you earn $1,000 of pre-tax income, you only get $610 of that in your pocket. However, if you put that money into superannuation instead, the tax rate's only 15%, so you keep a lot more of your money, $850 versus $610. Or to put it another way, if you want $1,000, how much pre-tax income do you need to get $1,000 on your home deposit? Well, you need $1,639 at your marginal tax rate, but you only need $1,176 to save the same amount in super. From a tax point of view, super is a much better outcome. The problem is if you're born after 1965, your super is locked away until you're at least 60 years of age. That'll change in recent years with the First Home Super Saver Scheme. There's now another use for super, buying a first home. One of the important things to note is it's only the voluntary contributions that you put into super after 1 July 2007 that can apply to this scheme. You can't use the money that was already in super, and you can't use the money that your employer is putting in for you. So why would you use the scheme? There's two benefits. It takes a lot less pre-tax income to save a deposit in super versus your own name, as we showed on the previous slide. And also the earnings on your deposit are much higher in super than on personal savings. For full details of the scheme, go to the ATO website and search for the quick code 54085. All the information I'm giving you today comes from that page. So let's look at eligibility. Firstly, it's not the same as some of the state-based grants. You're not excluded from using the scheme just because your partner has owned property. It's every man for himself. And you must never have owned property in Australia. So that means if you own a rental property but never had a home, you still don't qualify. But if you've owned a property overseas, home or investment, then you're still eligible, which works well for migrants to Australia who might be moving here in their 40s or 50s. They've had their home back home in New Zealand or in the UK or wherever it might be. They can actually still use this scheme for their first Australian home. Just a quick warning before you start, the ATO recommends you check with your super fund if they'll release the money that you can participate in that scheme with them. Some funds are limited and they have restrictions and you won't be able to do this. Most funds it should be okay, but check with your fund. So let's quickly look at an overview of the scheme. I won't cover all the details, but just enough to give you some ideas as to whether this might work for you. There's sort of three aspects to it: getting the money in, the earnings once it's in there, and then taking the money out. So let's start with contributions. There's a yearly maximum limit of $15,000 pre-tax. There's also a lifetime limit of $30,000 pre-tax. So you'd have to take at least 2 financial years to get to the $30,000 lifetime limit. But you could also equally use 5 years, so $6,000 a year for 5 years to get to that limit. There's no time limit on how long you can take to get to the 30 grand or how long it's in there before you can take it out. Limits are per person and not per couple. So for a couple, the maximum then would be 30,000 a year, 60,000 in total. Just be careful though that these contributions, if you're making pre-tax contributions under this scheme, they count towards your normal concessional contributions cap, which is 25,000 as a standard amount. You need to ensure you don't exceed the cap. You may actually have more than $25,000 now due to the carry forward super rules which came in this year. We can talk more about that in another video. But you need to check what your cap is and make sure if you are trying to go for large amounts like the full 15,000 that you're not breaching other superannuation caps. So how do you get money in super? There's two basic options. Salary sacrifice, which is where you make extra contributions from your pre-tax salary via payroll at work. You organise this with your payroll officer, and then they'll organise all the paperwork. You'll get less take-home pay, but instead you'll get more super. You can also make personal contributions from your own account directly into super. If you do that, don't forget to claim a deduction for those contributions by sending your fund a notice of intent to claim a tax deduction form. If you don't do that, you put the money into the fund, but you've not got any tax break, which defeats one of the major purposes of the scheme. If you're looking to get $15,000 per year into super and you want to do that via payroll, then these are the amounts for a weekly, fortnightly or monthly pay cycle. The time of recording of this video is early June 2020. If you try to get 15,000 in, you wouldn't have time to do that between now and June using salary sacrifice. So you'd have to go with the personal contribution amount if you wanted to get a large amount in before 30 June. So the next stage of the scheme is the earnings. So what do you earn? What sort of earnings can you expect to make once it's in there? So well, you're deemed to make a certain return on your money. So what your super fund actually does, if you're up, down or sideways, that doesn't affect what you can withdraw. The ATO gives you the shortfall interest charge rate, which is a rate it uses to apply penalties when you're late on your tax. It's currently 3.89%, just under 3.9%. So I'm not sure what you're getting on your online savings accounts these days, but I'm guessing it's not as high as that. So that's the second benefit of the scheme, not just the tax break, putting the money in, but the superior earnings rate once it's in there compared to cash accounts. And finally, let's look at the withdrawal phase. There are two purposes to apply for money under the scheme: purchasing a new home or constructing a new home. You have 12 months from the time you release the money or apply to release the money to sign a contract to purchase your home or to construct your home. If you do buy vacant land, you qualify for this scheme, or you meet the conditions of the scheme when you sign the contract to build. So you've got to be careful about the order in which you do things. So when you're ready to withdraw your funds, you need to apply using MyGov to get a first time super saver determination and release. You need to apply for release before you can sign a contract to purchase or construct a home. And if you're going to buy vacant land and construct a home on the vacant land, you need to make sure that you get the money released before you buy the vacant land. and then you sign the contract. Because if you own land, you then don't meet the never owned property condition, and so you can't get the money out. So let's look at our steps again. You need to apply for release of the money before the contract stage. If you do it after the contract stage, too late. Your money is locked into super under those normal rules where it's locked away till at least age 60. I've gone a bit clip art crazy there, but hopefully I've made my point. Timing is really important. Finally, there is a tax when you withdraw the money. So the money you release from super is taxed at your normal rate. So in our example, that was 39%, minus a 30% tax offset. So in our example, the tax rate will be 9%. Even with this small tax, you're still much better off saving via super than outside super. And the last thing I'll mention is, what if you change your mind? Or what if you've got 12 months? I mentioned before, you've got 12 months to spend the money once it's released. If you don't happen to buy a house in that 12-month period, that's fine. You can either repay it back into super to boost your retirement savings, or you can pay a penalty tax of 20%, basically reversing the tax benefits you got from putting the money in, and you can keep the rest of the money minus that 20%. So that's the basics of the first home super saver scheme. Hopefully that's given you a few ideas and a bit of help. If this is something that might work for you, but you're not sure about your contributions caps or when to put the money in, how to do it, how to claim a deduction for a lump sum contribution, anything like that, we can help you with tax advice and tax planning, help you prepare your tax return for the year where you get the money released, and you have to include that as your income. And we also can do mortgage advice. So if you're looking to get pre-approval for a home loan for your first home, then get in touch with us. We've got a joint venture with a mortgage broker who can organise that for you at no cost to you. So thanks for listening, and we'll talk to you again soon. Bye for now.